investor friends, I'm Michelle Markey, and recently I've been studying the company Netflix, which many of us have come to know and love for its shows like Bridgerton, La Casa de Papel, also known as Money Heist, The Crown, and Stranger Things. And lately, Netflix stock has been plummeting. It's off 69% from its fall 2021 highs, and it's gone from reaching a max of $701 per share to now being at around $215 per share the last time I checked. So it's gone down about 69% from its all-time highs, and that's incredible considering how it's been one of the pandemic darlings alongside Zoom and Peloton, and now a lot of that growth is peeling away as more people want to spend time outdoors. So it makes sense that naturally a bunch of the streaming services would lose subscribers, but the way that it's happened to Netflix has shocked many analysts, so it's kind of no wonder that its stock price plummeted after its earnings were announced on April 19 in the after hours, and then on April 20th, 2022, it fell by 35%, wiping off over $50 billion of market value. So it used to be around $300 billion of market value, and now it's at about $95 billion of market value. So it's been an incredible drop for Netflix, and recently I read this book by Reed Hastings and Aaron Meyer called No Rules Rules, where they talked about Netflix's culture of innovation, and it makes me wonder if they'll be able to reinvent themselves this time around as they're trying to figure out if maybe they can add subscribers through adding an ads version to make the price of Netflix subscriptions go down, or also go after the people who are sharing passwords to be like, hey, you can still watch Netflix, but give us some more change. So I'm going to share some of my thoughts and analyses on Netflix and whether perhaps its stock price could be on sale. So if that sounds good to you, please be sure to like and subscribe to my video and YouTube channel, and let's get into it. So what happened to cause a lot of investors to lose faith in Netflix? Well, on April 19, 2022, the company announced that they had lost a net of 200,000 subscribers in Q1 2022, and it actually would have been a net add of 500,000 subs if it hadn't been for having to pull out of Russia and losing 700,000 subs. But all of that is way different from what the company previously told investors, where they originally projected adding 2.5 million subscribers in Q1 2022, and analysts had been expecting them to add 2.7 million subs. And also, to add insult to injury, Netflix is expecting a loss of 2 million subs in Q2 2022, even though they had an earnings beat and a slight revenue miss, but it was pretty close. And overall, a lot of investors soured immediately on Netflix for even saying that they suddenly started losing subs for the first time since October 2011. So that came as a shock, and then maybe the amount of share sell-offs may not have been warranted, but it seemed to have caused a mass exodus in Netflix nonetheless. In addition, Netflix's growth appeared to slow down considerably since they'd been used to having 20% plus gains for years, and in the first quarter they delivered about 10% revenue growth, and that compares to their 10-year average revenue growth rate of 25% per year, and also their EBITDA average growth rate for the last 10 years of almost 30% per year. So considering all that, it seems like Netflix is starting to go in reverse, and that's not a good sign, as well as their total subscribers globally went from 221.8 million down to 221.6 million, which to me kind of seems like a drop in the bucket, and they should be able to still totally earn a lot more money on this huge subscriber base because its close competitors are still somewhat behind it, but catching its heels quickly, where Disney, including its Hulu and ESPN Plus services, is coming in at 196 million subs, and then Amazon Prime is at around 175 million subs. So it has a lot of close competition eating away at some of its margins, but they're still trying to keep its margins in the 20% range, even though that's down from the high 20% range. So Netflix still has somewhat of a competitive advantage, but it seems to be eroding a little bit, and I'm not sure how much competition and geopolitical turmoil, as well as rising inflation and maybe changing consumer taste, and preferences might be affecting Netflix, because they also increased their prices in January 2022 after they had last increased them in October 2020, and they raised them by about $1 to $2 depending on which service you got. So if you got basic, they raised the prices by $1, and then their standard package by $1.50, and then their premium package by $2. So even though technically you would think that that gives Netflix pricing power, maybe it doesn't anymore, since it seemed like it resulted in a net loss for Netflix in terms of its subs. And we'll just have to see if they're able to maintain their pricing power, or if their moat in their competitive advantages in offering pure streaming services compared to the others that have other things going on is still kind of there, or if maybe they have to change tack a little bit. And Netflix blames the pandemic for clouding their growth picture because they grew significantly in 2020, and then they believe that due to the COVID pull forward that explained their slowdown in 2021. And of course, all of that was before the events of 2022 unfolded, where we saw Russia invading Ukraine, and also the highest inflation we've seen in 40 years, and also Netflix's competitors taking away market share, where in Q1 2021, Netflix had half of the market, where they had 50%, and then that declined to 45% by the end of Q4 2021, whereas we saw Disney Plus and Co. taking about 2% more market share, as well as Apple TV Plus increasing by 2.5% market share as well. So all in all, Netflix has to figure out a way to innovate out of their decline in market share and sub count, and actually they have a lot that they should be proud of, because they grew so much that the difference from Q4 2019 to Q4 2020 was 36.5 million subs, where they went from 167 million to 203.5 million subs in only 1 year. And then since that point in time, they've grown by another 18 million, and that's as of Q1 2022. So in total, they added about a third from their Q4 2019 amount, which was about 54.5 million subs. So I think that Netflix should be proud of how much they were able to gain subs, and maybe they should be relieved that they didn't lose more subs, considering that we're starting to spend more time outdoors and don't really have to stay stuck inside watching Netflix. And I think that shows a lot of brand loyalty, that people are still willing to remain subscribed to Netflix even though they increased prices in the last 3 months. And maybe that explains why they lost 2 million subs more in Q2 so far, but we'll just have to see how much raising prices affects people wanting to stay with Netflix or not, because I know most of their competitors have offerings that are priced way lower than what Netflix is priced at, or equivalent to Netflix, but no other streaming service is priced above Netflix right now. And I also wonder if Netflix may have saturated its North American market, because it reached a height of subscribers in the US and Canada of 75.2 million subs in Q4 2021. And as of Q1 2022, it went down to 74.6 million. And I estimate that the Canadian subscribers might be around 7 million. So that leaves about 68 million in the US, which is about 20% of the population. So maybe Netflix will continue to stay focused on its global growth if its US market is totally maxed out, but they still have a pretty large captive audience considering. And if we look at how much they're charging people, they're kind of at the top of the range. So that's kind of good and bad, because they have significant pricing power, and that may be indicative of their moat. But the fact that they're entertaining the idea of bringing on ads, even though co-CEO Reed Hastings had been against ads for the longest time, he's now trying to change his stripes, because he's in favor of consumer choice. And if it means offering a lower price point at the cost of having ads, then he's open to it, if it means that they'll have a maintained subscriber count. And we can take a look at their pricing models, where if you just get Netflix Basic, that will run you $10 per month, and then their standard plan is coming in at $15.50 per month, and their premium premium plan is at $20 per month. And if you take their standard plan on an annualized basis, that works out to $186 per year. And that's without any discounts. And I know some people would love if Netflix had an annual subscription plan with a discount, but they don't. And then when we take a look at Amazon Prime, there are some levels that have discounted subscription rates. Like if you're a student, and that will get you at $7.50 a month. But if you go with Amazon Prime standard plan, that's pretty close to Netflix, and it's at $15 per month. But they do offer an annual plan at $139 per year. So that's a significant discount compared to Netflix. And they also have some original programming, but I'm not sure how much of this membership amount is attributed to their streaming service only, because I know that some of that goes to subsidizing, like if you get Amazon Prime shipping services and other benefits that Prime offers. And so it's kind of difficult to tell the full difference, but all in all, you're still getting Prime cheaper than Netflix. And with Disney Plus, that's coming in at $8 a month, and they have an annual plan for $80 per year. And then with Hulu, you can get that at $7 per month with ads and $13 per month with no ads. And then if you get the Disney Plus, Hulu, and ESPN Plus bundle, that will be $14 per month with ads and $20 per month with no ads. And then Apple TV Plus, with its popular hit shows like Ted Lasso, is one of the cheapest on here at only $5 per month. And then HBO Max comes in at $10 per month with ads, and then $15 per month no ads. And then Paramount Plus is also very cheap, like Apple TV Plus at $5 a month, and they have a premium plan at $10 per month. And if you want to get that with Showtime, that will run you at $12 per month for their standard, and then $15 per month for their premium. And they also have some annual plans. But all of this is way cheaper than if you were still signed up to cable providers like Verizon or Comcast. So it's no wonder that more and more people are cutting cable, where even if you as your family are subscribed to about 5 of these streaming services, that might run you on average about $60 per month. And compare that to basic TV providers like Verizon, where you're probably paying $80 to $100 per month on channels that you may not even be interested in watching. So if you cut cable, you could be saving at least $250 to $500 per year, not doing cable TV channels and just going with some of these streaming services. So I think that's still a pretty decent deal. And over the last few years, Netflix has been impressively growing its moat as an entertainment powerhouse by getting a record amount of Academy Award nominations at the 2021 Oscars by securing 35 nominations. And then that came down a little bit in the 2022 Academy Awards, but they still had the most out of anyone at 27, followed by Disney at 24. And then Apple came in at 6, with Coda winning Best Picture, and then Amazon came in with 4 nominations. So Netflix is far beyond most other movie distributors in terms of its popularity among viewers. So while they've been doing well there, it's come at the cost of taking on a boatload of debt, where they've been increasing their long-term debt since 2017 significantly, to the point where they took on a lot of debt in 2020 at a maximum of $15.8 billion. And then they lowered that in 2021 to about $14.7 billion. So it's still a significant amount of long-term debt that they've got on the books. And unfortunately, their free cash flows are not that great, where they had positive free cash flows in 2020, but they've been back to negative free cash flows in 2021. And for most of the last 10 years, they've actually had negative free cash flows. So it's a little bit difficult to tell how well they'll be able to service their long-term debt, because it looks like their current free cash flows are not nearly positive enough based on their last trends. But it depends on if they'll be able to maintain their cash flows to afford their debt, which is fortunately at low interest rate levels, and most of their debt is not coming due until 2025 through 2030. So that's a good thing in a way, that they have some time to be able to generate enough revenues and cash flows to afford their long-term debt. But it could be a worrying sign in the future and could affect how you might value this company going forward. And as far as what some super investors think about Netflix, it's a bit of a mixed bag, though it's leaning bullish. If we take a look at Dataroma's 8 super investors that own Netflix as of mostly Q4 2021, where it was slightly more bullish in buying Netflix compared to selling it. But the only one that's updated on this list was Stephen Ramick of FPA Crescent Fund, where he seemed to add to his Netflix position over the last couple of quarters. But Netflix is only 25th out of 52 positions, so he's highly diversified, and I don't put too much weight on that. But what's really surprising is Bill Ackman's moves, because he's a highly concentrated investor, so it kind of means a lot when he's willing to make a big move, and he did that when he bought Netflix at $1.1 billion worth in late January 2022, only to sell it in April at a loss of $400 million. So even though he had 3 million shares of it in the Pershing Square portfolio, he was willing to say goodbye to all of it because of, he believes, the story changed, where he wrote in a letter to shareholders that Netflix is modifying its subscription-only model to go after more aggressively non-paying customers, as well as potentially incorporate ads, which might not be such a bad thing. As a sidebar, Morgan Stanley analysts have estimated that Hulu brings in $3 billion from its ads, and it only has a subscriber base of about 60% of Netflix's North American subscriber base. So at 45 million subs, Hulu is bringing in $3 billion. So I would estimate that Netflix could bring in maybe $5 billion of revenues from ads alone. But that aside, Bill Ackman continued that because of these changes, it makes it extremely difficult for them to predict where the future subscriber growth will be, and the revenues, and also operating margins and capital intensity. And for all those reasons, he believes that he's no longer able to predict with certainty where Netflix's growth will be. And that's why they decided to make this really rapid change in their holding of Netflix to not have any of it anymore. But he wouldn't be surprised if Netflix will continue to be successful and if the investment will be really good at its current value right now. But for now, he seems to want to put maybe Pershing Square's money elsewhere, because he's saying with the Federal Reserve's policy shift, and also with geopolitical uncertainty and high inflation, that could lead to price volatility in securities. So perhaps it could be an opportunity-rich environment for Pershing Square soon enough. And who knows, maybe Pershing Square will buy back into Netflix someday, depending on maybe if Pershing Square comes to understand the evolving business model better, and if they get some of their confidence restored in their ability to predict where Netflix will be as a company. And the final note that I observed with investors is that Reed Hastings last bought Netflix in late January 2022 at around a similar time when Bill Ackman originally bought Netflix. So I thought that was a bullish sign for Netflix, but we haven't seen Reed Hastings buy more Netflix, even though if he was willing to buy it at about $390 per share, you would think that he should be willing to buy it now at closer to the low $200 per share range. And so it will be interesting to see if Reed is willing to buy more Netflix, or if more executive insiders at Netflix believe in the company, that they're willing to buy Netflix stock. So we'll have to pay attention to see what insider activity will be like in the coming months and years. And also, when I did some of my own valuation calculations, depending on if you gave Netflix a pretty low growth rate with a reduced price to earnings ratio, which right now it's trading at about 20 PE, you would get maybe a valuation of around $100 per share. But if you gave Netflix a higher amount of their earnings per share, like they've been doing in the last 12 months at getting about $11 earnings per share, then their valuation is more justified at what Bill Ackman originally bought them at around the $385 mark. So it's a pretty big range depending on which kinds of numbers you're using. And I think maybe a more reasonable reasonable earnings per share amount might be what it was before the pandemic at around $5 earnings per share. And then that might lower the valuation down to maybe $200 per share. So maybe it is on sale, but this is not investing advice. This is just some preliminary evaluation that I did, and I'm still learning to see if Netflix might be a good investment. So definitely do your own research and due diligence to figure out if Netflix might be a good investment or not. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.